Hello, my name is Alex Fisher, and I'm a volunteer with CPA Canada Financial Literacy. It's a pleasure to be here with you today to discuss a really important topic, which is growing your business. We have about an hour today, and I hope it'll be an interactive session where you will get a chance to learn something, but also a chance to ask some questions. So we're here today to talk about your growing a business. We have a packed agenda, which includes talking about managing growth and expansion, the key numbers to understand and monitor, doing the math, the ratios, doing a group session, which is a practical case study, talking a little bit about tax and tax-effective strategies, financing, and of course, leaving it off with some tools and resources for you, and as well as questions at the end. Small businesses are really important to Canada. We have about 2.4 million businesses, and about 90% of them are small businesses. So what do we define as a small business? Well, Industry Canada defines a small business as having between 1 to 99 employees. A medium business is having between 100 to about 500 employees, and a large business is really 500 employees and more. So the first thing I want to talk about is a really important concept, which is managing growth and expansion. It's probably one of the toughest questions entrepreneurs face, and that is when to do it and how to do it. So the first question you should really think about out of a multitude of questions is there increasing demand for your product and service? And what that means is, in order to expand, you literally have to be busting at the seams. You have to have more demand than you can keep up with. Your employees are really busy, your warehouse or the rooms that you utilize are really running out of space. So there has to be a clear business case for expanding. 2, does my company have the right skill sets and resources? So what that means is, when you're expanding, think about the complementary skills that you need to add to your business. So for example, if you're not good at accounting or bookkeeping, you might want to outsource an accountant or bookkeeper or get them on staff. That goes the same with operational marketing staff, web people. So think about the complementary skills that you will need to be able to manage the growth of that business. 3, what additional costs will be involved? And this is a really important consideration. So think about if you're leasing a building or a printer, you want to think about the upfront cost, the total lease cost, not only through year by year, but over the term of that lease. Employees are another consideration. Lots of people expand and they want to hire full-time staff, but don't appreciate that staff come with many hidden costs. There's not only an actual salary, but also what we would call incidental costs, such as pension benefits, unemployment benefits, workman compensation, and not to mention the fact that if certain employees get laid off, you might have to pay termination and severance. And the fourth consideration is, will the expansion actually increase your bottom line? And what does that mean? What that basically means is that if you expand, you're going to grow your revenue, but you want to make sure that you'll actually make some profit from that expansion. And if your revenue and costs are increasing at the same pace, there's no real impact to your bottom line. So you're working really hard, doing a lot of work, growing revenue, but there's no real impact to profit. Before expanding, there are some specific areas to keep in mind when considering growth. The first one is measuring profitability. Are profits increasing constantly, or are they just up and down? Remember not to focus just on sales. Sales can be growing, but profits aren't as well, then there's a problem. Also think about sales growing in peak periods or just busy periods. You have to differentiate between consistent growth and demand and just up and down fluctuations. Think about working capital and operating efficiency. A larger organization with more activity and costs will need more cash to run it. So think about it. Do you have enough cash or credit available to pay these costs? And maybe is it possible to grow your business and be more efficient with the resources that you have rather than expanding? And lastly, consider your distribution network. Can your network handle your growth? Do they have enough capacity to keep up with your growing demand? So now let's break for a small exercise. Can I get people to pair up or maybe work in groups of 3 and spend 5 minutes just talking about your business and your ideas for growth and how you expect to execute that growth? Then we'll debrief. So let's discuss the key numbers to understand and monitor. Part of having a successful expansion as growth is having good information, particularly financial information. So good and accurate monthly bookkeeping is super important. If you don't have a bookkeeper, one would be highly recommended, either a part-time one or one that's occasional, or investing in a bookkeeping software or system is really important. It'll allow you not only to understand your expenses and revenues and keep track of them, but allow you to do some analysis. Well, what type of analysis do I mean? The first one is to compare prior periods to actual. So how are your results in the current period comparing to the prior period? What's new? What's different? What's changing? And it's really important to understand those fluctuations. Compare your current results to your budget. And of course, it's very important to have a budget, but having that budget by itself without monitoring against that budget is quite useless. It's very important to have a budget and monitor against that budget. And the third aspect is you have your results for the period, but have you or do you consider comparing your results to competitors or other important benchmarks for the industry or business that you're in to assess how you're doing? So, to recap, important to compare your results to prior period, to budget, and to some kind of benchmark such as competitors. So let's talk about revenue or sales. Sales is one of the most important lines on your financial statements, and what it means is the amount invoiced to customers or clients excluding your taxes, which is HST or GST. Gross profit is another key item on your financial statements, and what that typically means is your sales minus your cost of goods sold, which is your materials and wages associated with that product. If you have a service business, your cost of goods sold is typically just the labor hours incurred to provide that service. So if you take a look at an income statement or a profit and loss statement, you'll see sales or revenue, less your cost of goods sold gives you your gross profit. Your gross profit then allows you to cover all of your remaining expenses. And remember, revenue is only a starting point. There's no point in increasing revenue if it doesn't contribute to the bottom line. So now let's talk about expenses. It's very important to keep track of your expenses, but for analysis purposes, it's not really efficient to list your expenses in alphabetical order or by specific detail. It's better to aggregate them into categories. So as you can see, we have some suggestive categories: operating, administrative, selling, marketing, depreciation. And depreciation, for some of you that are wondering, is really an accounting term that allocates the cost of an asset over its useful life. So what do I mean by that? Let's pretend you have a printer that you buy for $500 that's meant to last 5 years. From an accounting perspective, the cost of that printer shows up over that 5-year period, $100 over 5 years. So depreciation reflects that $100. When analyzing your income statement or expenses, it's important to look at the big picture, to look at the trends of what's happening and what costs are really eating up your bottom line. Focusing on those costs and anomalies will really allow you to be more cost effective and efficient and help your business grow. So let's talk about operating profit and EBITDA. Operating profit is your profit earned before interest and taxes. So it's really the profit that you've earned before financing and before the cost that you have to pay to the government. EBITDA is earnings before interest, taxes, depreciation, and amortization. And it's used as a proxy for cash flow. And remember, cash flow is key to your business. Net income and net income before tax. So net income is really the bottom line of your business. It's really what you're left with after paying all of the expenses. If it's negative, you have a problem. That means you're losing money. And you really have to ask yourself, how long can you sustain those losses for? 1 year, 2 years? And more importantly, how are you financing those losses? Is it through debt? Is it through credit card debt? And remember, debt, particularly credit card debt, is quite expensive. The balance sheet. The balance sheet is really the financial position of your company. Some of the information that you can obtain from the balance sheet can help you create an accounts receivable aging schedule and an accounts payable aging schedule. So what an accounts receivable schedule allows you to do is to take a look at all of your accounts receivable outstanding by bucket or days outstanding. So one bucket could be all amounts outstanding for 30 days. Second bucket could be all outstanding from 30 to 60 days, and you go on. And it's important because it'll allow you to see which accounts receivables have been outstanding for quite a long time and allow you to follow up with your customers so you can actually get paid. Remember, cash is critical to the success of your business. The faster you can collect cash, the better off you'll be. Accounts payable. Accounts payable is really the opposite of accounts receivable. And it's important to also know the amounts you owe to your suppliers. 1, so you can take advantage of early payment discount, but 2, so you can avoid penalties. And remember, those Early payment discount and penalties can make the difference between making a profit or having a loss. Doing the math and some key ratios. So we're going to talk about some key ratios that you need to know and why. They include gross profit margin, operating margin, current ratio, quick ratio, or sometimes known as the asset or liquidity test, accounts receivable turnover, and debt to equity ratio. So let's do some math now. Let's look at some key ratios. So the first one we talked about was gross profit. And remember, gross profit is your revenue or sales minus your cost of goods sold gets you your gross profit. If you want to turn that into a ratio or percentage, you take that gross profit and you divide it by your sales. And what it gives you is a ratio or number that depicts how much revenue is really left to cover the rest of your expenses. Your profit margin is a deeper view of gross profit, which means is that it also takes into account the rest of the expenses. So it takes your operating profit divided by your revenue to give you your operating margin, which is really the margin that you have left or the revenue that you have left after paying all of those expenses. There's a gross profit margin example included with the slides. Feel free to use that example or one that you create. Current ratio. So a current ratio is really a liquidity ratio that shows how liquid your company is. A liquidity ratio measures your company's ability to pay off short-term obligations, ones that are due with less than a year. And typically, you want to have a current ratio that is higher than 1. How do you calculate the current ratio? It's your current assets, those assets that you intend to realize, cash, receivables, inventory, divided by your current liabilities. Your liabilities that you intend to pay off within the next year, such as accounts payable, wages payable. And again, the desire or the intent is to have your current assets being higher than your current liabilities. Quick ratio. So the quick ratio, or another way known as the asset test, is really an offset of the current ratio. And what it does is subtracts from current assets those less liquid assets, such as prepaids and inventory. And it basically leaves in things like cash and accounts receivable. And you divide that by your current liabilities. And it provides a picture of more liquidity or a more liquid picture. And again, the key is to have the ratio of a little bit higher than 1 or 1.1. This metric is really important to many lenders, particularly financial institutions. Accounts receivable turnover. Accounts receivable turnover is a really important ratio to monitor because it monitors the rate at which you collect your accounts receivable. And again, accounts receivable are the funds that are owed to your company from customers. The faster you collect those funds, the faster cash comes into your company, the better off you'll be. So the accounts receivable turnover ratio is calculated as your net credit sales, which is really your sales less refunds and returns, divided by your average accounts receivable, which is the average for the past 2 years or so. And in our example, you have 200,000 divided by 20,000 of accounts receivable gives you a rate of 10, which means that you're collecting your accounts receivable 10 times a year. And if you want to equate that in days, you say, well, a year has 365 days, and you collect 10 times a year, which basically equates to collecting every 36.5 days. Remember, the higher the ratio, the better it is. That means you're collecting accounts receivable more or faster and faster throughout the year. Debt to equity ratio. This is a solvency ratio, and it shows the degree of leverage in your company, meaning the degree of debt in your company relative to the equity of the company. It's an important ratio for banks. They want to assess your ability to repay, and this is one of the ratios that they'll look at. The way it's calculated is your total liabilities, amounts that you owe, divided by your equity, the amount that's invested in your company. And in our example, we have 60,000 divided by 100,000 gives you a ratio of 0.6. So the lower the ratio, the better it is, because it indicates that you have less debt in your company. So now what we're going to do is we're going to try to apply these definitions, terms, and ratios to real-life examples. There's a sheet called the matching game that I'd like you to work individually or in groups, and I'll give you guys about 5 to 10 minutes to complete this task, and then we'll take it up. I'm going to walk around the room as you're doing it, just in case you have any questions. So now let's do a case study. Scarves of the North. So the objective of this section is to allow you to apply the skills that you've just learned to a real-life scenario of an existing business by looking at their financial results, analyzing their financial results, and thinking about cause and effect relationships of the numbers in this example. So what I'd like you to do is I'd like to split you into groups. Pair up into groups of 2 or 3. Review the case and analyze the numbers. Answer the questions on the handout, and remember to think beyond the numbers. We will take this exercise up in about 10 to 15 minutes. If you have any questions, I'm going to walk around the room and feel free to ask me. Some may be unclear about what is meant by think beyond the numbers. Walk around the room and try to suggest to people to think qualitatively. Imagine what is causing the numbers to be what they are. What qualitative factors are contributing to revenue growth and gross profit being decreasing? Let's talk about Scarves of the North. So revenue has grown, but it seems that the revenue growth is slowing year by year. In year 2, we had 160% revenue growth. In year 3, we had 59%. In year 4, only 35%. Gross profit also has been decreasing through the years. In the first year, we had 83%, second year 75%, third year 69%, and fourth year 65%. So the questions that people might be wondering is, well, why is that the case? Why is gross margin decreasing? If you take a look at the details, you'll see that websites contribute to 83% of the gross margin, while retailers only have about 50% of the gross margin. And the trend is to be selling more to retailers that are less profitable to the overall company. Expenses have also increased over the years. Administrative expenses have gone up to $6,000, salaries up to $7,000. And so we have to think about what are the causes or possible causes that are resulting in these numbers increasing. Well, for salaries, we can think about in the first year, the mother-in-law really donated her time, so there were real no salary expenses. But as the business continued to grow, the company had to actually incur salary costs to continue to support operations. Administrative expenses could be increasing to keep pace with the business, so you could have bookkeeping, web maintenance, order processing costs going through. And then you think about it, why is also revenue growth decreasing? Some qualitative factors to think beyond the numbers. Well, there could be competitions from knockoffs or other sources, competitive environment sources that are causing sales to decrease. So the question really comes, should we continue to expand and maybe get into different lines of business than scarves? And if that is the question, is this a viable strategy? What should you do to maintain those costs? And are there any costs that you can decrease to salvage your company? A key thing in this case is that the company is experiencing losses and continuing to operate. So the question arises is, how can a company continue to operate if it incurs losses? Most likely it's because the owner themselves are funding the business through debt, maybe even credit card debt, both of which are very expensive. So it's again a point where you should really consider, is this a business worth continuing to invest in if it's incurring these losses? Let's talk about tax, effective tax strategies. So corporate income tax rates in Canada for small businesses, those businesses that have income of less than $500,000, is about 15%. 11% federal, about 4% provincial. And those rates apply on what we call active business income to small companies, like I said, with less than 500,000. Those companies, which many of you would fall into, have several tax strategies available to them. The first one is paying a salary. Salaries themselves are increasing costs to the business, which will allow your net income to decrease and lower your taxes. Now, of course, that salary will be taxed in your hand, but there are some benefits of paying yourself salary. The first benefit of paying yourself a salary is that you get to earn what they call pensionable earnings. It allows you to contribute to your pension plan, Canadian pension plan. The second benefit of paying yourself salary is because it gives you RSP contribution room. What that means is that if you have a salary, then you're eligible to contribute to your retirement savings plan. Now, as a business owner, you could pay yourself a salary or dividend. And the Government of Canada tries to basically equate the two, that you're not paying any more or less tax by the choice. However, there is an optimal mix. And in order to calculate that optimal mix, I would highly suggest seeking the advice of an accountant that specialize in this tax, that they could really find that optimal mix for you. Be aware of management fees. Management fees are things that you can pay yourself out. Again, it'll increase expenses for the business, lower the income, which will lower your taxes. But those management fees have to be reasonable, and they also have to be for specific work performed. One of the best tax strategies is income splitting. If you have a wife, husband, kids, and they do work for the business, you could actually pay them a salary. So what that does is it shifts some of that income from yourself, who could be a higher earning taxpayer, to a lower paying taxpayer. As an example, someone earning about 90,000 pays tax at about 44%. Someone earning about 20,000 pays tax at about 20%. So just by paying your spouse or kid $10,000 for doing real work, you could save, or your family unit could save, about $2,300 worth of taxes. Income splitting from a dividend perspective. If your capital structure in your company allows it, meaning that your spouse or children have shares in your company, you can pay them a dividend. Now, what that allows you to do is that for the person receiving the dividend, if they're in a lower tax bracket, let's pretend they're not making any income in the year, they could receive up to $40,000 worth of dividends tax-free. That's tax savings. And the last part is about deferring taxes with a bonus. So what that means is the corporation can accrue a bonus, basically record a bonus that is payable to you. That will increase their expenses, lower their net income, which will lower taxes. And the corporation has about 180 days to pay out that bonus. But you only get taxed when that bonus gets paid out. So if it gets paid out in the next year, the corporation gets the benefit of the deduction and pays lower taxes, and you're not taxed for at least a year. The strategy only works if the calendar year of your company is on or after July 6th. This section is quite heavy and technical. Please allow time for people to ask questions and or give some scenarios and practical examples to shed light on some of this content. There may be people in the audience that ask specific questions about draws from the corporation, about employee versus contractor, about remittances, including pay remittances, penalties, fees, contractor and employee reporting, CRA training for small businesses. These are all important topics. If you have time, please do share any information that you may have, or refer them to the CRA website or to a qualified tax accountant. Let's talk about financing, particularly what major lenders and investors look for and what numbers they want to see. The first thing they want to see is they want to see a business plan and proposal. And your proposal should answer the most basic questions about what is your product or service, what value or is it adding, what problem is it solving, how does your product or service differ from the ones currently in the marketplace, how much money are you asking for, and what are you going to be using that money for, and what would be your ability to repay. One of the best suggestions you can provide to the audience is to possibly watch Dragon's Den. Dragon's Den allows people to see the tough questions that are being asked of entrepreneurs, particularly regarding their proposal. So let's talk about the numbers that bankers, investors would want to see. The first thing they would want to see is a detailed listing of your startup costs, including operating costs and capital items that you would need, such as property, plant, and equipment. The next thing they'd like to see is a projection of your revenue for at least 3 to 5 years and with your gross profit margins. And thirdly, and this is probably one of the most important things they'd like to see, is they'd like to see a cash flow projection. So what is the cash on a monthly basis for the first year and for the second and third year, at least on an annual basis, that you expect to get in, and what sources are you going to be spending your cash on? And that's really important for the bank to see and understand your cash flow position. Make sure that your proposal answers at least the following key questions regarding the numbers. Sales. How are the numbers projected? Are they reasonable? Are they supportable? Do you have any quantifiable or evidence to support the numbers that you're projecting? Equity. Where is your equity coming from? What sources? And loans. The loans that you're asking for. How much and what period are you asking for? Sources of investment and financing. So the most obvious one would be the bank. So the bank will probably want to look at your business plan and proposal, including your cash flow projections. But one of the things that your bank may want as well is some involvement from your accountant or bookkeeper or auditor. The first type of involvement they may ask for is a compilation or notice to reader. What that is basically a compilation or an aggregation of your numbers into financial statements. So an accountant can help you compile those numbers so you can reasonably present them to the bank. The second type of involvement would be a review. In this case, the bank may ask an independent auditor to come in and do a sanity check on the numbers in your company, just to make sure that they make sense, they're reasonable, and follow a credible accounting framework, such as generally accepted accounting principles for private enterprises, which is accounting standards for private enterprises, or in very rare cases, IFRS, which is International Financial Reporting Standards. And in some cases, the bank may also ask for an audit. And that's probably the highest degree of involvement from an auditor. It's quite expensive. It's quite expensive because the auditor will need to come in and take a detailed look at your books and records and accounting. They'd ask for invoices, examine property, plant, and equipment, interview management, possibly the board of directors, in order to provide an opinion on your financial statements that they're not misstated in any material ways. I would discuss with your bank the best option to pursue because each of these options has different costs and effort required. In addition to a business plan, a bank often asks for a personal guarantee to ensure that the funds will be repaid. Now, the personal guarantee could be from you or a spouse or a family member. In addition, they may ask for certain collateral, such as collateral of your house, car, or other property, all in a way to manage the risk that they won't get paid back. Private lenders. One of the best sources for capital is private lenders, primarily friends and family. If you've exhausted your friends and families, you could look at venture capital, private equity companies, international trade financing companies, even equipment financing companies can help you out. And they're a good source of financing to go to. A good source of information for private equity companies is Canada's Venture Capital and Private Equity Association, CVCA. I would recommend that as a possible link for people looking to get more information. SR and ED grants. So Scientific Research Experimental Development Program is a program from the federal government of Canada, and it provides cash incentives, tax incentives, and rebates to certain individuals that qualify from doing research and development work. That funds or incentives or rebates can be used for certain expenditures such as paying wages, purchasing equipment, or related research and development expenses. Crowdfunding. Crowdfunding allows you to seek funds from the general public in an easy and efficient manner. There's great websites such as Indiegogo or Kickstarter that could help you raise funds for your particular venture or business. We've compiled a list of some very useful tools and resources for you to consider, to get more information on, and as a look back if you have any questions. In addition to these resources, I would highly recommend going to your accounting firm, your banker, and even visiting some of the Government of Canada websites that relate to small businesses. They all can provide very useful information to help you grow your business. We've come to the end of our session, so at this time I can take any additional questions that you may have. If there's any questions that you cannot answer or don't feel comfortable answering, please refer them to their financial advisor or qualified accountant. I'd like to thank everyone for coming out today. I hope you found this session informative and will help you grow your business. If you have any questions, please feel free to come and chat with me after the session. Thank you.